Hello and welcome to Unit 9 of Topics in Governmental Financial Analysis, focusing on risk analysis. We'll begin by talking about what I mean by risk and why it's important to analyze it as a part of evaluating the financial health of a government. And then we'll look at some specific disclosures and other information that you can look at to evaluate risk, including those related to deposits and investments, derivative instruments, contingencies, and other risks. So when we're talking about risk in this context, we're talking about the possibility that there will be some kind of financial harm to the government, most likely through the loss of some of its assets or the value of some of the assets that it has, especially investments, loss of cash flows from investments or other sources, liabilities that may have been remote or not expected at all, and the ability to deal with unexpected shortfalls in revenue or increases in expenditure during the course of a year. So at this point, everything we've been looking at, we haven't really questioned the information that we're looking at in the financial statements and notes. We've calculated the ratios and accepted at face value the amounts that are being reported. But a lot of values that are placed on assets and liabilities, in fact, change on a regular basis, and particularly things that are measured at fair value, which changes on a routine basis, on a daily basis, on an hourly or a minute-by-minute basis, depending upon what type of asset or liability you're talking about. And so that's where risk comes in, because you have this possibility that you could have an adverse change in the value of assets or liabilities that will diminish the financial health of the government. And so in analyzing risk, you're trying to ascertain how likely it is that the government will be affected negatively by these risks that it faces. When we're talking about investments, investments almost always are reported at their fair value, unless specifically excluded from being reported at fair value in the governmental accounting standards. An investment is defined in GASB Statement 72 as a security or other asset that a government holds primarily for the purpose of income or profit, and with a present service capacity that is based solely on its ability to generate cash or to be sold to generate cash. And so, we're not just talking about stocks and bonds and treasury notes and things like that. It could be a piece of property or a business that a government acquires, not to use it to provide service, but to generate income for the purpose of financing the provision of service or the operations of the government. Fair value is defined in the governmental literature very, very similar to the way it is in the FASB standards for-profit and not-for-profit non-governmental organizations. It's the price that would be received if a government sold an asset, or the amount it would pay to transfer a liability in an orderly transaction between market participants at the measurement date. So this is an exit price. This is what a government would get if it got rid of the asset or got rid of the liability, which in a lot of cases is exactly the same amount as an entry price, what it would pay to acquire the asset, or what it would cost if it incurred a liability. But for assets and liabilities that are not traded on active markets, like a stock exchange or a commodities exchange, the chance that there is a significant difference between exit price and entry price increases significantly. So it's important to note that it's an exit price. It's also important to focus on the fact that this is market-based, that fair value predominantly is looking at what the prevailing amounts are, prices are in the market for that asset or liability. And it's also important to note that it really depends upon the unit of account at which you're reporting the asset or liability. An individual asset, or liability, might fetch a particular price when you're measuring its fair value, but if you're looking at it in the aggregate in a portfolio, the fair value that the government determines may not exactly be the same, because the act of selling it or transferring the liability or satisfying the liability may not be the same. In the governmental literature, there are at least three approaches that can be used to determine fair value. The market approach, basically involves looking at market quoted prices and basing the fair value on that. The cost approach has to do with determining what it would cost to, for an asset of similar service capacity. And the income approach generally involves projecting future cash flows and discounting them to their present value. The quality of the information that goes into a fair value measurement is described in a hierarchy of inputs called level 1, level 2, and level 3, with level 1 being the preferred method of establishing fair value. It's a quoted price in an active market for the exact same assets or liabilities. This is completely reliable information because anybody can go and check what those prices were on a publicly traded market as of the date when you measured the asset or liability. Level 2, if there is no level 1 inputs for establishing fair value for a particular asset or liability, level 2 are also observable inputs because they're quoted prices, but not for the identical asset or liability, for one that's similar to the one that you're measuring. Or it's a quoted price for the exact same asset or liabilities in a market that's not active. Or other than quoted prices, something other than a quoted price on a market, but that is still observable and verifiable by someone outside of the government. And then lastly, if there is no level 1 or level 2 inputs, a government will use level 3 inputs, which it is developing based upon the best information that is available to the government. But these inputs that go into that calculation are completely unobservable to people outside, and so these are considered to be the least reliable measures of fair value. And there are disclosures that governments are required to make, and I will show those to you, to tell you instances in which they're determining fair values using something other than level 1, and then you can make your own judgment about the reliability of that measure and to what extent the fair value of their investments and other assets are dependent upon these unobservable inputs for determining their value. You should also know that some investments can be reported by governmental entities other than retirement plans and endowments at amortized cost. And what we're talking about here are essentially very, very liquid, very short-term investments like money market investments. So the government has an option to report those at amortized cost, which essentially is the original cost of the investment plus an accumulated amortized premium or discount. The government will disclose to you in either the summary significant accounting policies or in the investment disclosures any assets that are any investments that are being reported at amortized cost. Or if there are other investments or other assets that are specifically excluded from being reported at fair value, they will describe in the notes how they determine the value that is reported in the financial statements. If there are any limitations on the types of investments that a government may have, and that's the case in some states where the state very strictly limits what governments are allowed to invest in, often limiting them to just U.S. Treasuries, that will be disclosed in the notes as well. As I mentioned, there is a disclosure of fair value inputs to tell you, as of the end of the reporting period, the fair values that are being reported, what they are what types of inputs were used to determine them. Also, any valuation techniques that the government uses to establish fair value, such as projecting cash flows and discounting them to their present value, or other methods, all those will be described in the investment note disclosure as well. And this is what that fair value level of input disclosure might look like. And you can see they have the investment shown by type of investment. In the statement of net position, you might only see this aggregated total number for investments, but this is breaking out the fair value. And actually, the number would probably be larger because if a government has investments that aren't reported at fair value, they're not going to be included in this amount. So this is just the investments at fair value, and then showing you going across here what level of input was used to determine those fair values. So the mutual bond fund had quoted market prices and active markets for the exact same assets, level one. Most of their investments, their fair value was determined using level two inputs, and then these residential mortgage-backed securities were actually based upon level three inputs. So let's look specifically at the disclosures in the notes to the financial statements that are required for deposits and investments. When you're looking at cash deposits, your interest is in something called custodial credit risk, which is the possibility that the bank or other firm that is holding the government's deposits or investments as well can't return those government's assets to the government when the government requires them. Deposits often are protected against custodial credit risk through the use of insurance, such as for you get this insurance for your deposits as well, the FDIC or Federal Deposit Insurance Corporation, but that obviously only goes up to a certain level. I'm not sure what the amount is anymore, but it might be something like $100,000. There are some states that provide some deposit insurance above and beyond what the FDIC provides. But if the government's cash deposits are greater than that, then there's a portion of them that isn't protected by insurance. Another way it can be protected is by collateral being put up by the bank or other financial institution that is holding the deposits, as long as that collateral is held by an external party other than the firm and in the government's name. So what governments are required to disclose is when their deposits are actually exposed to custodial credit risk. So meaning there's no insurance, or the collateral is held by the bank, or it's held by the bank's agent, but not in the government's name. So those are the instances in which they are exposed to custodial credit risk. And this is what a typical disclosure might look like, where they're showing of their insurance deposits, this is the amount that is both uninsured and uncollateralized, and uninsured and it's collateralized, but it's held by the bank's trust department and not in the county government's name. So this is the portion that you might have some concern that under severe circumstances, for instance, if that bank goes under, that the government won't be able to get its cash back. Credit risk is the possibility that the entity that issues an investment that a government purchases, that investment will not perform as it's supposed to, mostly meaning the government won't get the cash payments it's expecting to get in return for its investment. A related concept is called, I just talked about custodial credit risk, which investments, if they're purchased by a government but being held by another institution, investments could be exposed to custodial credit risk. And then the related concept is concentration of credit risk. Now, if you have some credit risk, but it's only for a small percentage of your investments, then that risk is not as concerning as it would be if you have credit risk associated with a very large portion of your investment portfolio. And so concentration of credit risk is looking at instances in which a government has investments in a single issuer of investments, other than federal government and federally guaranteed things like U.S. Treasuries, investments in mutual funds, and investments in government-run investment pools where any risk is dispersed among all of the participants in the pool or in the fund, and no individual participant is exposed to a specific credit risk. So if a government is exposed to a risk, such as credit risk, it's required to disclose the risk, and for each of the particular risks that are required, and I'll go through each one of them, there's information that a government is required to disclose if it is exposed to that risk, and it should also disclose the policy it has for dealing with that risk, or disclose the fact that it doesn't have a policy. So here's what a typical disclosure might look like, and this government is exposed to credit risk. So what it's required to do is disclose the credit ratings of the investments that are exposing the government to credit risk. And so it's looking at what the rating agencies have assigned to these various investments that are exposed to credit risk. If a government has investments in a single issuer of investments equal to 5% or more of its total investments, then it is required to disclose that it is exposed to custodial credit risk, and it will disclose the amount and the investee that it is invested in that it exceeds that amount. You can see that this government has a policy for dealing with custodial credit risk that limits how much it can be holding to no more than 5 million. And then, this is custodial credit risk. I continue to keep confusing those two, and I'm sorry about that. So this is an instance in which there is a counterparty or another entity that is holding some of the government's investments, and so the government's policy is to limit how much counterparties can hold to no more than 5 million. This government does have concentration of credit risk. It says here that its investment in this particular commercial paper equals more than 13% of its total investments. It also says here that it doesn't have a policy for dealing with concentration of credit risk. So what a government might have is a policy that says, for instance, that it won't invest in any one entity, any amount that's more than 5% or more of its total investments, in which case it would never be exposed to concentration of credit risk. But since this government doesn't have a policy, it has to disclose that it has no policy for dealing with concentration of credit risk. Interest rate risk is another one of the most common risks that investments face. As you know, the longer the maturity on the investment, meaning the further off into the future before it pays off, the greater the potential return. You're essentially loaning your money to the investee to use for an extended period of time, and the longer they have your money, the more they have to pay you in return. So the investment returns are expected to be higher. But at the same time, the longer it is until you get the payoff on your investment, the greater the opportunity for something to go sideways and for the government to lose the value of that investment or lose it entirely. And the impact of any adverse change in markets is greater the longer the maturity, because the impact compounds over time. So the longer that you've got it, the bigger the impact on the value of the investment. There are several different ways that a government can disclose its exposure to interest rate risk, and the standards, which in this case is GASB Statement 40, encourages governments to use a disclosure format that is associated with the way that they try to manage interest rate risk, to track it and to limit it. Probably the most common form of disclosure you see is what's called a segmented time distribution that looks like this, where you're seeing their investment types and the fair value, and then that fair value is broken down by the maturity. The amount's less than a year. So you see most of their investments that are measured at fair value, almost 2/3 have a maturity of less than a year, and so their exposure to interest rate risk is greatly diminished. But the further you get out here, 1 to 5 years, 6 to 10 years, more than 10 years, the exposure to interest rate risk grows. And so what you're looking at here is to see, what percentage of their investment portfolio has a lengthy maturity that could expose it to interest rate risk. Another way to disclose it is by showing the weighted average maturity, which is essentially looking at any group of or types of investments and looking on average when they are going to mature. This in particular disclosure is showing the weighted average maturity in months. So you can see up to this point, it's all a half a year or less. This is almost 18 months for the corporate bonds, so that's a year and a half. And then on average, they're less than 7 months the maturity of this portfolio. So you might compare that with the maturity of other governments, similar governments' portfolios, or track what's happening with weighted average maturity for this particular government over time, or compare it to industry benchmarks. A somewhat more complex version of weighted average maturity is called duration, which takes into account not just how much is invested and what the ultimate maturity is, but when the payments are expected to take place. Because if you're looking at two $10,000 investments, both with a maturity of 1 year, but one of them is expected to pay off, in full, 1 year from now, and the other one pays off in installments between now and then, the getting those installments earlier, is going to lower the interest rate risk because you're not waiting the full year to get the entire amount. So in this case, you can see duration is measured by months, and there's a little bit there. This one's probably exposed to a little bit more interest rate risk. These U.S. agency notes, which are you should feel are fairly safe in most cases, but their values do change, sometimes significantly, particularly in a market downturn. Those have a duration of a little bit more than 3 years. These 22 months, so that's almost 2 years for these taxable state bonds. Corporate bonds, 8 months, 2.5 months for these repos. And then overall, an average duration of 9 months. So these have, a higher duration, are more exposed to interest rate risk, but there's a relatively small percentage of this government's investments that are in those types. So this is, about 5% of the total fair value of these investments. And again, like weighted average maturity, you can examine this government over time to see if the duration's going up or down, and compare it with other governments that are similar, and with industry benchmarks. And then lastly, you don't see this very often, but another way governments can show interest rate risk is to show how sensitive the fair value of their portfolio is to increases in interest rates. So, what would happen if their fair value that's reported for the year is $3 million? What would happen if it went up by 100 basis points? That's 1%, or 2%, or 3%, and you can see how much that reduces the value of their portfolio. And obviously, the greater the reduction, the more sensitive the government's portfolio is to interest rate risk. In addition to those disclosures, governments also should be disclosing if they have any investments that are highly susceptible to interest rate risk. The most common form of this is when there's a kind of kicker, in the investment that says, whatever the change is in a particular rate or index, the change, in the investment's value is going to be something more than that, 1.5 or 1.25 times that. So maybe it's predicated in some way on the London Interbank Offering Rate, or LIBOR, and it says that for any percentage change in the LIBOR, the change in the value will be 1.25%. So it won't have just the normal effect on its fair value, but it will have a greater than normal effect because this kicker is in the terms of the investment. If a government has investments that are denominated in foreign currency, there's a risk that there'll be a change in the relationship between the dollar and the value of that foreign currency in a manner that would reduce the value of the investments. A government should disclose any deposits or investments it has that are denominated in foreign currency and the amounts, in each of those currencies, because they are at risk for changes in exchange rates. One thing that I should note too is that if a government's not exposed to a particular risk, then you're not going to see any disclosure. So if there's no disclosure for foreign currency risk, for instance, that means the government isn't exposed to foreign currency risk, most likely because it doesn't have any deposits or investments that are denominated in a foreign currency. Two particularly common forms of transactions, particularly among larger governments, are repurchase agreements and reverse repurchase agreements, otherwise known as repos and reverse repos. In a repurchase agreement, a government purchases an investment from another party, usually a financial firm, and then the other party is required at some date in the future to repurchase that investment from the government. And a reverse repurchase agreement just flips the relationship. The government is selling the investment to this other party and promises to repurchase that investment at a later date from that party. So, if you want to look at this visually, in a repurchase agreement, the government's giving cash to the investment firm, which gives it the securities, and then later on, the investment firm has to purchase those securities back from the government. And in a reverse repurchase agreement, the government is getting cash, from the investment firm and giving them some particular securities, and then the government takes the cash and makes a separate investment with them. So it's betting that this second investment it makes with that cash is going to bring in more money than it will need to repurchase those securities at that future date. So clearly, the creditworthiness of the counterparty to these transactions exposes the government to credit risk. There's also the risk that the investment that it sells in a reverse repo will lose its value, so by the time it buys it back, it's not worth as much as it was before. And then probably the biggest risk is investment risk in a reverse repurchase agreement, in which the government invests the cash that it receives for selling the investment, and then that investment that it purchases with the cash doesn't pan out. And so the government doesn't have as much money as it needs in order to repurchase the investments that it sold, or it doesn't pay off in time for it to have the cash. So it's going to have to dip into its pocket in order to conclude the reverse repurchase agreement transaction. Securities lending is very much like a reverse repo, except rather than selling the investment, the government is loaning the investment to another party. And so, in this case, the government continues to report the investment because it still owns it. It's only loaned it to this other party. Whereas with a reverse repurchase agreement, it would remove the investments from its books because it actually has sold them and no longer owns them, even though it has promised to rebuy them at a future date. So securities lending is exposed to the same types of risks as a reverse repo. So I think you can ask this question now, and looking at all these disclosures that governments are required to make, is why is investment risk such a big deal? And one of the reasons may be that governments may have a very significant investment portfolio. That's certainly the case if you're looking at something like a retirement fund. Obviously, almost all of their assets will be in investments, and so it's a particular concern for them. But a lot of governments have sizable investment portfolios as well. Some particular types of business type activities like universities and hospitals have very sizable portfolios and expect to get a pretty significant amount of revenue from their investments. So it's important to know if the value of that portfolio is going to remain steady or grow, and if the government, in fact, is going to get the amount of income that it's expecting to get from its investments. So if there's any chance that the value of the investments could decline or that the government will lose some of the cash flows that it expects to get from its investment income, you really need to know about that because that's going to affect its ability to pay its bills, to repay its debt, and to continue functioning.